This is the Legacy Radio Network, and you are listening to the Everything Financial Radio Show. I'm your host, Dennis Tubbergen. Glad you're joining us this week. We have a lot to talk about. Best-selling business author and economist Harry S. Dent Jr. is on the show today. Very excited to have Mr. Dent on the show. His latest book, The Great Crash Ahead, we'll be talking to him about. We'll be taking a couple segments to chat with Mr. Dent today, so very glad that he has taken time out of his schedule to talk with us. Also, a senior economist that resigned from the International Monetary Fund this past week issued a blistering attack on the International Monetary Fund, alleging that the International Monetary Fund deliberately suppressed economic evidence that Europe was heading for a debt crisis. Very strong words, and an article in the UK publication, The Telegraph, talks about it. The Greek Prime Minister told former U.S. President Bill Clinton, who was visiting Greece this past week, that Greece is in a Great Depression similar to the one that America experienced in the 1930s. And I am going to compare with you for you today some data from the 1930s and today. Certainly something you'll want to stay tuned for and pay attention to. Also, CNBC says that the data says we may fast be approaching another recession. I'm going to give you my view. And also, the fourth city in the state of California this past week stated that they may be looking to get protection afforded through bankruptcy. Well, if that's the fourth municipality, no matter which school of economic thought you subscribe to, that cannot be good news, economically speaking. Also, I'd like to offer you, if you've not already gotten it, our 2012 guide, Surviving a Market Crash. It presents all the evidence as to where we are economically, gives you three potential outcomes and scenarios and what you might do to protect yourself in the event of each of these scenarios. You can go to investingapproach.com. That's investingapproach.com, and get your complimentary guide sent to you. You'll just want to enter your name and the address to which you would like the guide sent, and we'll be very glad to send it out to you. Again, the website is investingapproach.com. Also, our discovery groups, they are filling up quickly. If you have attended a discovery group in the last 3 months, please do not register to attend. However, if you have not, I'd like to invite you to go check out our dates and locations. We'll be in the West Michigan area here a couple different times in August. You can go to personallegacyseminars.com, personallegacyseminars.com to get more information. I am very pleased to have back with me today on the Everything Financial Radio Show Mr. Harry S. Dent Jr. Mr. Dent is the president and founder of H.S. Dent, which publishes the H.S. Dent Forecast and the H.S. Dent Perspective, and also oversees the H.S. Dent Financial Advisors Network. He is the New York Times best-selling author of The Great Depression Ahead and wrote The Great Boom Ahead, a prophetic work back in 1993. His most recent book, which we'll chat with him about, is The Great Crash Ahead. Mr. Dent holds an MBA from Harvard and is a Fortune 100 consultant. And Harry, thank you for coming back on the show. We're glad to have you.
Yeah, nice to be back, Dennis.
Harry, let me jump right in. In your book, The Great Crash Ahead, you state that deflation is the trend. Yet our listeners have heard us talking about the money printing spree that the central banks around the world are engaged in. And more money, at least listening to some pundits, means that we will have inflation just around the corner. My question for you is, do you still believe that deflation is the trend, and can you explain?
Yeah, deflation is the trend because if you look at history, you always see deflation at times when you see major booms and fueled by debt bubbles with asset prices rising, in bubble-like form, and then those bubbles and those debt bubbles unravel. Because you're creating money by all the debt and leverage, and then when that debt gets written off and those asset prices fall, you're basically destroying money and net worth and value. And when there's less money in the economy, finally, then there's fewer dollars chasing goods, and the price of goods go down. And again, home prices go down, stock prices go down, commodities, everything. Yeah, we are getting inflationary policies, no question about it, and we anticipated that. But you have to understand that the government's going so far in trying to inflate the economy and print money, precisely because they know they're fighting deflation. Their biggest fear is not inflation right now, even with unprecedented money printing. Their fear is deflation, because in deflation, debt deleverages, banks get in trouble, you get high unemployment. I mean, we know what it is. That's what happened from 1930 to 33. That's the greatest debt deleveraging bubble of the last century. Japan had one in the 1990s. Now, they did massive stimulation, were able to keep deflation at bay, but people who think in the hyperinflation camp that trillions and trillions and trillions of dollars of stimulus will cause massive inflation, all you got to do is look back at Japan. Japan did twice the level of QE that we've done thus far, and we may end up catching up with them in the end, but twice the level and ended up with zero inflation for 2 decades. Twice the level of quantitative easing. You know, it would have been the equivalent of us putting $5 trillion in quantitative easing in Japan's economy, and they got zero inflation. And they were going to their crisis in the 90s when the rest of the world was booming, and we had a mild inflationary trend, so that offset it too. So even at the extreme, the most bullish thing is you get no inflation, and our scenario is more that, no, you're going to have many countries melt down. There's debt bubbles around the world. They're all melting down at the same time. And, yes, once we get over this phase where the government does one stimulus plan after the next, once people in the bond markets realize that each stimulus plan has less and less effect, which has been the case, and that's what we've been saying, people are going to lose faith in this stuff, and the government's going to lose the capacity to keep doing it, and or bond markets are going to start penalizing them rather than rewarding them, and then the system melts down, and then you get deflation. So it's a matter of how much deflation and when. There's no way you're going to create substantial inflation out of this scenario.
Harry, interestingly, you brought up the 1930s, and in your book, The Great Crash Ahead, you talk about the economic winter season in which we find ourselves, and we have very bright listeners. They are educated as to the Kondratiev wave theory. Give us your view as to what lies ahead for the United States, and comparing it to the 30s, how will what lies ahead for us compare with really the devastation that the world experienced in the last economic winter season of the 1930s?
Well, first of all, we do go through 4 seasons. Spring, like the early 40s through the 60s with the boom, and then the mid-60s through the early 80s with rising inflation and increasing recession. That was summer, sluggish summer. And then the bubble boom of the 80s, 90s, and early 2000s. I mean, that's fall. Winter comes after a long-term technology cycle, after a major generational spending cycle, when things need to deleverage. And the fall season creates bubbles, and bubbles aren't all bad. They create a lot of innovation and new business models and all types of things. But winter is a necessary season. It's not something the way the Fed looks at it. And economists like to be avoided. It's like my mother looked at teenagehood. She just wishes you could just wipe it out and say, hey, let's just not have teenagehood and adolescence. Adolescence leads to adulthood. You don't get from childhood to adulthood without adolescence. You don't get to the next spring boom, the next technology revolution, until you go through winter and leverage out the excesses. Now, another thing to mention about the Kondratiev wave, our 80-year, 4-season cycle that we cover in The Great Crash Ahead and all of our books back for a couple decades is the Kondratiev wave. Most people, the Kondratiev people, it used to be like a 50 to 60-year cycle pretty regularly. Well, that was when commodity cycles, which run more like 29, 30 years, were dominating our economy. Once we had the first true middle-class society start to emerge in the early 1900s, that brought us into a generation-dominated cycle where new generations have way more spending power, way more innovation power, and they create booms and busts in 40-year cycles. So the old Kondratiev wave was two commodity cycles, which added up to about 55 to 60 years, and the new one is like 2 generation cycles, which adds up to closer to 80 years. So that if you look at the Kondratiev cycle of rising inflation and then flattening and then peak inflation and then disinflation and deflation, which is winter, we have the same cycle. It's just been stretched by massive population and baby boom generation, and it's been stretched by the generation cycle lasting longer. It's the same cycle. And so the winter season we had from 29 to 42 is now going to be a kind of a similar winter cycle. You could count it all the way back to 2000 by some ways of looking at it, and it's going to last into the early 2020s. And the winter cycle is about debt deleveraging. It is about whole new technologies emerging, like nanotechnologies, robotics, biotech, and things like that, things that are going to do things nobody could believe decades down the line, standing today. And the winter season is necessary to force consolidation and efficiency, but mainly to throw out the bathwater and keep the baby. That's what it's about. In a long boom like we had, we really had a long boom with some interruptions in the 1970s, starting from World War II forward. We just created greater and greater debt, greater and greater innovation, greater and greater growth, and, it's just human nature to overdo things. So we need to take out these excesses, and the Federal Reserve and central banks around the world and the ECB and the Bank of China and the Bank of Japan are all saying, we can't have winter. It's too painful. Well, that's like saying to a drug addict, okay, it's too painful to go through detox. Just keep taking more crack until you die. That's what we're doing, and it's actually scary to me.
We're having a fascinating conversation with Mr. Harry Dent. We will get his opinion on where the stock market is headed and what you might do to either take advantage of this direction or protect yourself when Everything Financial Radio returns after these words. Stay with us.